Okay, so now we're going to look at working together 8.3. In 8.3, we are looking at accrued expenses. Okay, so accrued expenses are expenses that are incurred in one period and paid in another. Okay, so even though we like to keep everything nice and neat in one fiscal period, we want to match our revenue with our expenses in one fiscal period. Real life isn't that neat and tidy. Okay, we're going to have things that overflow from one period to the next, from one year to the next. And so this is the process to help follow the concept of matching revenue with expenses and keeping up with everything that's happening. So the first thing it tells us to do in working together 8.3 is that we need to use the following information to journalize the adjusting entries for interest, payroll taxes, and warranties on December 31st of the current year. Okay, so this is all about adjusting entries. The first thing is that we have a note outstanding on December 31st. It was a 90-day note with 10% for $30,000, and it was dated November 16th. So on November 16th, we recorded the note payable. Okay, as we saw in a previous lesson, then when we pay it, we calculate the interest. We have to find the due date, and then we calculate the interest and pay that interest back with the full amount of the loan on the due date. Well, now we've got a situation where we are jumping from one year to the next. So on December 31st, we're not paying back the loan, but we need to record the amount of interest that should be expensed for that time of that year. Okay, so on November 16th is when we acquired the loan or the note. Okay, so November 16th to November 30th is 14 days, I believe, right? Yeah. Okay, so that's 14 days. And then December has 31 days. Okay, so we've got a total of 45 days in the current year that we need to expense our interest expense for. Okay, so we know that the math is the principal, so 30,000 times the 10% times however many days out of the year. Okay, so 3,000 times 10% times 45 divided by 365, and that's going to give us 369.86. So even though we're not paying this interest right now, we need to record this interest right now. So we're going to do an adjusting entry. For this on December 31st. Okay. We're wanting to figure out what the expense is. So we know we're going to increase our interest expense for $369.86, and this is interest payable. Okay? All right, so this is taking care of the accrued interest that's happening in the year, even though we're not paying it until next year. All right. The next thing they want us to do the adjusting entry for is payroll. Okay. Now, the reason that we have to do this is if we're in a situation where we get paid every 2 weeks, or we do payroll every 2 weeks. Okay? So let's say that we've got December, and we've got the 28th, the 29th, the 30th, the 31st, and the 1st. There's a Monday, Tuesday, Wednesday, Thursday, Friday. Okay? Because it tells us that this is December 28th to December 31st payroll information. Just these 4 days. Well, this is January 1st. Then we have the weekend, so that's the 2nd and 3rd. And then back to Monday, Tuesday, Wednesday, Thursday, Friday. Okay? So here, if we pay every 2 weeks, this is payday on January 8th. But here's the end of our fiscal year. So we've got to match revenue with expenses and take care of these accrued expenses for salary expense, Social Security payable, Medicare payable, all that good stuff for those 4 days. And that's what we're doing. Okay? And it gives us the numbers for it, so that's good. We don't have to go do all the calculations. That's wonderful. We just have to know how to get it into the journal correctly. Okay? So if we're going to record, we're not paying it, we're just going to record the pay information for a partial period, which is at the end of our fiscal year. Okay? Salary expense. Okay? And then usually we do salary expense, FIT payable, Social Security payable, Medicare payable, and there are other things like health insurance, retirement, those kinds of things come out, and we pay it with cash. Okay, well, in this situation, we're not paying it yet. We're just recording it. So we've got to put somewhere that net pay information that's usually cash. So it's going to be a salary payable. That's going to be our credit instead of cash. FIT payable. That's federal income tax. Social Security payable. And Medicare payable. Okay? So we have a debit here. And we have a credit, and a credit, and a credit, and a credit for all the payables. And then, of course, these 4 credits equal this single debit. Okay? And like I said, the book gives you those numbers. So that's simple enough. We don't have to go through the whole process of calculating that, like Accounting 1 has just finished doing. Okay, now the other part, this is the employee side of payroll taxes. The employer also has to pay some payroll taxes. So the second entry is payroll tax expense. Right? And then the 4 taxes that employers have to pay are Social Security, Medicare, and these are matched. So whatever you pull out for the employee, the employer also has to match it. Okay? It's the same amount. And then the unemployment. So the FUTA payable, federal unemployment tax, and state unemployment tax payable. And again, luckily you don't have to do all the calculations and know the percentages and all that good stuff. The book's giving you the numbers. Okay, again, the expenses are debit, the payables are credit, and all 4 of these credits equal the expense debit. Okay? All right, so now we need to get this into the adjusting entry for the end of the year. Okay, so back to our adjusting entries. On the 31st, salary expense. Salaries payable. Employee income tax payable. And again, I'm good if you want to write FIT, federal income tax payable. Social Security payable. Medicare payable. And like I said, it gives us the numbers. So the salaries are $3,200. Okay. The federal income tax, is $280. The Social Security tax is $198.40. And Medicare tax is $46.40. Okay, so remember that this is also going to be a credit. It's usually a cash credit when we're paying, but in this case we're not paying, so it's still a payable. And we just have to take our total earnings minus our deductions to come up with that number. So 3,200 minus 280 minus 198.40 minus 46.40 should give us 2,675.20. Okay, and that was the employees part of payroll taxes. Now we've got to get the employers part with payroll tax expense. And it's the four that employers must pay. Social Security payable, Medicare payable, FUTA, and SUTA. And again, the book gives us that. So Social Security tax should be the same as it's up here because we are doubling it. So $198.40. Medicare $46.40. Federal $480. And state $32.40. And those four added together will give me my payroll tax expense, which is $282. Okay. All right, so that takes care of Part B. And then Part C says estimated warranty costs per item sold. All right, so basically, with warranties, when you sell something that's going to have a warranty, you go ahead and make an estimate as to what you're going to have to pay on that for any kind of repairs or coverage. So it's similar, not exactly, but similar to allowance for uncollectibles. Okay, we're preparing for bad things to happen. By our product breaking and we have to replace it because we have a warranty for it. Okay, so it tells us that the warranty cost per item is $8 and the unit sold is $18,900. So all we have to do is multiply those two to get our number. So $8 times 18,900. Again, this is on the 31st. Warranty expense. And accrued warranty liability. Okay, so 8,000 times 18, or $8 times 18,900 is 151, 200. Okay, so that takes us through number 1 in the working together for 8.3. Now, we've talked about reversing entries. Reversing entries have to happen for our interest expense and our salaries and payroll tax expense. So let's see, do I want to show this first? Okay, I'm going to show you kind of how it's working. Okay, we know, simply said, we know that reversing entries are just the opposite of adjusting entries. But I want to go over how this kind of happens. Okay, so we're going to use interest as the example. Okay, so we have a note, just like the one we had in the book, where it covers the end of one year and the beginning of another year. And so we had to record the amount of interest that we are accruing during that time period when we're actually going to pay it the next period. Okay, so the first thing that we do is we make that adjustment. Okay, we made the adjusting entry here. All right, so we made the adjusting entry for it first. And this is for that partial part of the period, right? And again, all of this is about matching revenue with expenses within the same fiscal period. Okay, so when we did this, I'm going to try to use some T's. We have interest expense and interest payable. Okay, those are the two accounts that we use here. We debited interest expense and we credited interest payable. And I'm just going to use a round number of 300. Okay, so now what happens is after adjusting entries, we do closing entries. Okay, and expense is an account that gets closed, right? So when we close, interest expense goes to 0, right? Interest payable, nothing happens to it. So it's still at 300. Okay, we still have a $300 credit. All right, now when we reverse this entry, okay, interest expense and interest payable, okay, and we're just reversing it. So interest expense, $300 on the credit side, for expense, and payable, $300 on the debit side. We just reverse it, right? Well, look what happens. Interest expense was at 0. Now it's got a $300 credit. Well, credit is, interest, the normal balance for expenses is a debit. So this is kind of a negative balance now. Okay? So now expenses has a negative or credit balance. Okay? Interest payable is what? Here we had a credit, here we have a debit. Okay? This is down to 0 when we reverse it. Okay? And that's good because when we actually want to pay it, we'll pay the whole amount. We'll recalculate the principal times the percent times the to figure out the full amount that we owe, the number of days that we had that loan, okay? And we'll pay that full amount. When we do that, we will also record the full amount of the interest. Okay? So when we record, let's see if I can get all this down. When we actually pay our loan back plus interest, when we actually pay, we will record the full interest. Okay? In interest expense. Okay. But with a negative balance or a credit balance, it'll total the correct expense for this current year. Okay, so let's say that the total interest that we're going to pay for this loan is $800. Okay, I'm going to draw another T. Right now, we've got interest expense sitting there with a $300 credit balance. Well, when I pay it in total, I'm going to record the payment of the note plus interest expense of $800. Well, what happens? My balance in interest expense is now only really $500. So this is accurate for this period. This was last period. We took care of it when we finished out that year. This is the correct amount from January to whenever it is we finally paid the note. Okay? Hopefully you were able to follow that. So, let's get back to, let me find all my papers again. 8.3, working together. So this again says, journalize the appropriate reversing entries on January 1st. So, you've got another general journal specifically for this. Okay, we don't have room to put it in this general journal. Okay, and actually this is a new year, right? So this will be on January 1st. Because we make the reversing entries on January 1st to get everything correct to start with again. Okay, and you are basically reversing your adjusting entries. Okay, we don't do a reversing entry for warranty though. Okay, all right, so interest expense and interest payable. $369.86. Okay, again, just reversing the adjusting entry. Okay, and then same thing for salaries. January 1st. Salaries payable. Employee or fit payable, Social Security payable, Medicare payable, and salaries expense. Okay, same numbers, 2675, 280. Oh, that's a 20. 2675, 20. Let me clean that up for you. $280, $198, 40, 4640, and the salaries expense 30,200. All right, next one. January 1st. This is our payroll tax expense. So Social Security tax payable, Medicare payable, the 4 taxes we have to pay, FUTA payable. I don't mind you abbreviating or shortening, just don't leave off the word payable.